Hi there. Today we're tackling one of the biggest style choices in stock investing, anywhere in the world. Growth stocks versus dividend stocks, two very different ways to build wealth. Why do Apple, Microsoft, and Nvidia, the big tech names that dominate the ASIC, pay little or no meaningful dividend yield? Meanwhile, banks, energy firms, and utilities often send you a fat dividend check every year, yet their share prices tend to crawl higher more slowly. Once you get that trade-off, you can allocate your money a lot more intentionally, whether your portfolio is mostly U.S. names or a mix of U.S. and international holdings. Look at Apple's daily chart on screen. You need to understand the playbook behind tech and growth names like this. These companies mint enormous cash every year. Apple alone often generates well over $10 billion a year in free cash flow. They could hand most of that cash to shareholders as dividends, but they usually don't prioritize a high yield. Instead, they pour it into AI chips, data centers, R&D, and other bets on tomorrow's growth. In plain English, they skip paying you a big dividend today, so the business, and hopefully the stock, can compound harder tomorrow. Now look at SCHD, a popular U.S. dividend growth up. Inside you'll find banks, energy, utilities, and other mature cash machines, the kind of names you also see in European and global dividend indexes. These businesses typically pay out about half to 70% of their earnings as dividends. Picture a bank that earns $10 million in a year. It might send $5 to $7 million of that straight to shareholders as cash dividends. Why? Because the business is already stable and mature. It doesn't need to reinvest every dollar to survive. The strategy is to maintain the franchise, return cash to owners, and let the share price grind higher over time, rather than chase hypergrowth. Look at the ASIC 100 on screen, a tech-heavy growth index. Stack it against SCHD, and the valuation gap jumps out. P/E, or price to earnings, tells you how many years of profits the market is paying for. If a company earns $10 a share and the stock trades at $300, the P/E is 30. Historically, big tech and growth names often trade around a 30 to 40 P/E, while banks and energy names often sit closer to 15 to 20, a pattern you see across U.S. and many developed markets. Why the spread? The market prices in high future growth for tech and lower growth for mature financials and energy, so today's price embeds those expectations. A low P/E is not automatically a bargain. You have to weigh growth alongside the multiple before you can call something cheap or expensive. Picking growth versus dividends is really a question of how long you can sit through the ride. Nasdaq 100-style growth baskets swing hard. SCHD-style dividend growers usually have milder drawdowns, though nothing is immune when the Fed hikes and risk assets sell off together. In your 30s, you may have 20 to 30 years of investing runway. If you can stomach volatility, a heavier growth sleeve can make sense on paper. In your 60s, you might have closer to 10 or 20 years left in the workforce. Collecting dividends while protecting principal often fits better. Your personal stress tolerance and cash flow needs can diverge from your age, so weigh both, not just the birthday on your passport. In practice, many of the world's best-known investors don't choose only one style. They blend. Warren Buffett, for example, has long owned dividend-paying financials as a base while also building a large stake in Apple, a growth compounder. That mix aims for stability and growth at the same time. Useful whether your core is the S&P 500 or a global equity up. One illustrative glide path, some professional sketch. In your 30s, roughly 60% growth and 40% dividends. In your 50s, closer to 40% growth and 60% dividends. As you age, you tilt toward dividends to dampen volatility without giving up all long-term growth. Treat those percentages as examples, not rules. Look at the ASAC 101-year chart on screen, then compare it with SCHD, the dividend growth. Historically, in bull markets, the ASAC 100 often climbs much faster. In bear markets, dividend names often fall less. That pattern shows up across U.S. and many international style indexes. That's the style difference in action. Match it to your age, goals, and risk tolerance, including how much currency and country risk you're already taking if you hold assets outside your home market. Ask yourself, how much volatility can I live with? And how many years do I still have to invest? Then size the mix from there. This lesson is for education only, not a recommendation to buy or sell anything. You own every trading decision. See you in the next lesson.